Should the markets worry that actually the Trump administration is now weaponizing the economy in dealing with foreign policy?
Well, I think the rhetoric, I think the concern, and we're seeing this play out in the Treasury market. Obviously, you highlighted, Treasury yields down again today. So I think what we're seeing is that rhetoric being geared up. It was first directed at China and now somewhat surprisingly overnight. I think there is a question whether this is a strategy by Trump to get the Democrats to approve the current MCA or the new MCA deal. But, I take the point. I think it is a serious increase in rhetoric, and it is something that Trump is using, and it appears to be gaining broad political support within the US. So I think that is the concern. I think markets have now become almost expectant that the China-US trade situation is not going to be resolved quickly and not necessarily at the G20. But this escalation of trade concerns, it is worrying for markets. It's why treasuries are continuing to rally. You highlighted earlier where bond yields are, where JGB yields are. We're close to the all-time lows in those markets. This is pretty remarkable.
So the fact that President Trump is going after Mexico, does it make it less likely that he does a deal with China in the short term?
Yeah, it's just hard to judge, right? Yeah. Because I think it just tells you, he feels he's on the front foot. He can be a little more sort of forceful around dealing with those. Does that play across to China? I'm not sure, but it probably tells you they're not necessarily in a mood to do a deal quickly. And so, again, I think markets are sort of taking that on board, that we could be in for a period of increased trade wars.
Are markets taking on board? Let me bring you over to my chart, which basically just looks at world market cap, and we've lost some $4 trillion this month. In worst case scenario trade war, I mean, how much what does it mean for equities? How much does it mean that it's shaving off global GDP?
Yeah, well, it definitely is shaving off some growth. Our own forecast for China, we sort of took down by 2 or 3 tenths on the back of this trade escalation. If we went to tariffs, 25% tariffs on all of the trade, we think that could be another 3 or 4 tenths off China. Similarly, a few tenths off the US, and so suddenly, yes, you're getting 2 or 3 tenths off global GDP. And I think to some extent, when you look at Treasury yields, bond yields, JGB yields, they're starting to factor in a much slower growth world.
I mean, so half the people we speak to think that Treasuries will be around 2.15, 2.75 for the 10-year yield, and then some are saying no, it's going to go to 2. What would it take for Treasury yield to go to 2?
I think we'd need to see either the labour market really slow, and of course we've got, a week today we'll have non-farm payrolls. So far it's actually the labour market's been pretty strong. We've gained over 800,000 jobs already this year. So I think if you had some slowing of that, or the inflation numbers, and again, we have inflation expectations coming out this afternoon from the University of Michigan survey. So I think the Fed will be reluctant to sort of endorse this move unless you see a rollover of the labour markets or inflation continuing to come lower. But I think it's interesting, the market is pricing in cuts. So at some point, the Fed has got to resist that if they're not going to move.
Okay, but are treasuries and actually the government bonds telling us we're in a recessionary environment? Whether you look at the inversion, in the past, the bond markets have always been right.
Yeah, look, inversion has typically been a good guide. It's not every single time, and of course it depends on which part of the curve you look at. 230s, 530s are still positively sloped. So it depends on which part of the curve. But it's telling you the world is slowing and there's no inflationary pressures. And I think, that's fair. Whether that is enough for the Fed to cut or not, I think is another question.